So let's just think about what we need to consider at the end of an asset's life, or at the end of a project's life. I mean, it's pretty clear that when we finish up a project, it's unlikely we're going to have the project just petering out and there's nothing left. We may have some assets left that we can get rid of, for which we get positive cash flows. We might need to actually spend money to get out of the project at the end to remediate, for example, a mining site. And if we're making additional payments or we're getting rid of an asset, those things will, of course, also have tax implications. As we've already noted, there may be a loss or a gain on sale of the asset at the end of the project. So what we're going to have at the end of the life is recovery of current assets, and including that recovery of current assets, we're going to use up any inventory we happen to have in that project. And so by selling off that last inventory, letting the accounts receivable money come in, collect the cash, we don't need to reinvest in that. At the end, we're not making any additional credit sales. We're not purchasing any additional inventory. So the working capital is coming back to us. And as I've already noted, we're going to be selling off the equipment. It will have some value. That value may be negative. We might have to pay to get rid of it. But there will be some tax implications for that as well. So coming back to what I said about inventory, remember that working capital is accounts receivable, inventory, less accounts payable. The amount of money we've got tied up in just running the business. And that's money that's not available to be used somewhere else. Now, as we get towards the end of the project, we're going to sell up that inventory. We're not going to build up any more accounts receivable. And those cash flows, I mean, what happens with accounts receivable? Your customers give you some money, but at the same time, you're making some sales. So there are some more sales that increase the accounts receivable again. So accounts receivable on balance is going to be roughly the same amount over the life of the business, or it will be bigger if the business is growing. But as you're winding down that business, the amount of accounts receivable comes in as cash, and it's not replaced with new accounts receivable. The inventory is not replaced with new inventory because you're winding down the business. So the return of that working capital is, in a sense, a sort of cash inflow that happens at the end of the project.